In this video, I'm going to talk about what to do before you start investing in the stock market. And in this video, I'm going to talk specifically about how I approach stock market investments and how I go about it and kind of some of my common practices. I think the first issue is that so many people are considering stock market investment not really as an investment. They're not approaching it like an investment. They're approaching it more as a game or a kind of an entertainment. I know there's a lot of out there, and you want to share your stories about how you did 100% on this particular day on a stock and all of that. I mean, it does happen. But this is not what I'm looking for. If this is what you're looking for in this video, I mean, I'm not gonna talk about these kinds of things. What I'm looking for is a repeatable process, something that is gonna be more attuned to what a professional investor would do, and where it is driven on the numbers and not so much on emotions. And I think the first thing to do is really look at what is the goal. Why are we investing in the stock market? Why are we investing at all? Also, when I'm going to compare these different methods, these different ways of investing, I want to make sure that we are comparing apples to apples. I'm going to set the goal as achieving financial freedom. So this is the number one goal, as I mentioned, that everybody should achieve first. Then you can do whatever you want. If you've already achieved financial freedom, then you're at that point. Most people haven't achieved that yet, so I think it's important to focus on that. So basically, these investments that I'm going to be talking about in the stock market are going to be focused towards achieving that goal. And specifically, I'm going to talk about strategies that you can implement, investment strategies that you can implement in the stock market that's going to get you closer to that goal. Whenever you're looking at any of these investment strategies, you want to make sure that you have the right time to allocate to that resource, to learn the skills that's needed to invest in that particular strategy, and also that you have the right capital for investing in that market. If you already have a portfolio, a stock market portfolio, you may do something, you want to have passive income, right? To achieve financial freedom, you want to minimize the amount of time that you're spending on investing. So day trading is not going to fit in too much with the passive income, the financial freedom technology. Day trading is a job. So assuming that you have a portfolio right now, you can use something that's called the 4% withdrawal method, where you're basically, for the first year, you are withdrawing 4% of your asset, and then every following year you're adjusting that initial amount that you are withdrawing, and you're adding inflation on top of that. And the underlying assumption here is that your portfolio is going to have a rate of return of about 6 to 7%, which you will more on average, which will compensate then for your 4% withdrawal. So you should be able to sustain, to use that and leverage your portfolio for a very long period of time. So if I had $1 million portfolio, the first year I would withdraw $40,000, the 4% of that portfolio to live on. If I want to, the next year, then I would add inflation on top of that. So if the inflation, let's say, is 2%, then I would add $800 on top of that. So $40,000 and $40,800 for the following year, etc. And just keep adjusting to inflation. Whenever we're looking at investments, we have to look at taxes. So this is a critical component. Some taxes are pretty heavy. If they are ordinary income, you can go in the top bracket on the federal side to like 37%. If you are in a state that also taxes on ordinary income, like California, then you can add it on top of that, another 17% on top of that. So I'm going to assume that that stock portfolio has been kind of invested for a while, and then you would be basically qualify for the long-term capital gains, which is about 12% tax rate at that point. The other consideration is around fees. I'm going to assume there are no fees. You don't have any kind of like withdrawal fees, that this money is not necessarily in a 401k where you have to pay fees to get them out. You don't have a back-end loaded mutual fund that you have to take out. So I'm going to assume that there are no fees. If you have fees, you may want to include that in the calculations. What kind of stock should be part of this portfolio? I would say some very solid stocks that have good market caps that are going to be around for a very long period of time. So I would definitely consider things like Apple, like Amazon, you know, and then you can pick like solid portfolio like that. Don't be all in high tech either, so try to diversify in other markets. You can also look online and they have some recommendations also for allocation, but I wouldn't pick 50 different stocks. I would pick 10 to 20 solid growth stock that have a solid balance sheet that you know they're going to be around for another 10, 20 years or more. Another option would be to buy the ETF for S&P. So that would be ideal. In fact, in 2008, I don't know if you saw that article, but Warren Buffett challenged hedge fund industry to basically go head to head with him over a period of time to invest in the stock market using his method, actually using ETF. And then the hedge fund who have been claiming that they know the market better, they know how to, and they're much more active on the market than other investors. From 2008 to 2016, Warren Buffett made a cumulative return of 85%, and the hedge fund made only 22% return over that period. Using the ETF is a solid investment, and you don't have to worry about what could happen to the market and having to do the transaction, or what could happen to a specific stock. The final consideration then is, I want to achieve financial freedom, and then so how much money do I need to achieve financial freedom? How much money do I need in that stock portfolio to achieve that? So I'm going to assume that we want to have, as financial freedom, we want to get $5,000 in passive income per month, and that's about $60,000 a year. As I mentioned before, for this particular, the 4% withdrawal method, we have a 12% tax that we have to pay. So that means that instead of $5,000 a month, I need $5,700 a month in order to cover the tax and end up with net amount of $5,000. So in order to withdraw that 4% per month and get that $5,700 a month, I need to have $1.7 million in my stock market portfolio in order to do that, in order to have that passive income. So a significant amount of money, but quite feasible. Another option that is often discussed is using a portfolio of dividend stocks. In terms of taxes, again, this is the dividends are paid for joint people, joint filers. It's 12% tax rate. And then we're going to try to figure out how much money do we need in a dividend portfolio in order to achieve our financial freedom goal. So I looked around for some, I'm not a big dividend investor, but I was looking at some recommendations from professional about a dividend portfolio, and they would recommend like things like Waste Management, which was a 2% yield on their dividend. Pfizer was a 4.5% yield, and Exxon was 6.65%. So I was kind of assumed that a portfolio of maybe 3, 5, 10 dividend stocks that would give you a yield of about 4.5%. So if you assume that yield and you still want to make that $5,700 a month in order to get your pay taxes and get $5,000 net, you would need $1.5 million in a dividend portfolio in order to have your passive income goal, to reach your passive income goal. So these are pretty straightforward strategies. You basically hold a stock or hold an ETF, and then it grows and you don't have to worry too much about it. This is pretty straightforward. There are other things depending on your skill level that you can go into, and one of them, probably the simplest one, is using options. So the first two options, really there's no leverage associated with that, and this is something that's kind of missing. But with the call options, there is a little bit of leverage here that you can use, and this is pretty interesting. There are thousands of option strategies. I'm gonna talk about one here that is fairly simple, requires you to have some of the stocks and also do an option, and the strategy is called the covered call option. And the idea is that it works very well if you already have a portfolio of stocks, of the right stocks, where you can do these covered calls pretty well. But basically the idea of the covered calls is that you have, let's say, 100 shares of a company, of Apple, let's say, and you can go and sell a call contract for 100 shares of Apple, and you can sell that on the market and somebody's going to buy it. Next is that if the stock market remains stable or goes below the strike price, then you're fine. The call options basically expires and you're good. If the stock price goes up and above the strike price, then the call options will be exercised, and you're going to sell. You're going to be forced to sell your stocks at that particular strike price. So you're going to get a bunch of money at that point. So what you're losing is really on the upside of the stock price, but what you're gaining is basically being able to have some money up front that is yours and guaranteed, leveraging really your existing stock. The idea is that with your portfolio, then you would kind of look like 2 or 3 months ahead. So this is not exactly a passive strategy like the dividend or like the 4% withdrawal rule. This one is a little bit more active. You have to look at your stock portfolio at least once or twice a month. You don't have to spend too much time on it, but it's really about looking at these at your options, and look at the strike price and the stocks, and then see what you need to do with that. But really, the call options that you're doing, they're going to be spread out over 2 or 3 months ahead, maximum. So that's the idea here. When the call options gets exercised, then you sell the actual stock. So that could trigger a tax event where you have to pay capital gains tax. So there's the one option there. When you sell the call options, that's going to be considered income as well. So these two components, you're going to have to pay some taxes. If you're in the long-term capital gains, and you may end up between 12 and maybe 25% tax bracket. It is something to be considered. You're going to pay a little bit more taxes. It's not as passive as the other investments, so you're going to have more fees as well associated with these transactions. The other component is how much money do you need in order to be successful at this strategy. And the reason is that it really depends on the underlying stock that you are using, and also the call contracts, the demand on these call contracts for these stocks. So if you look at GameStop, which was at 43 the other day, you can sell a covered call at 50. So you want to have your call options that you're selling higher than the current price of the stock, right? Because you want to make sure that basically what you don't want it to sell really. You want to kind of maintain it, keep control of that stock, and then just get the money for your passive income from the sale of the call. So you can sell that covered call at 50 strike price for April at $9.45. So that means that if you do that, you're gonna get $945 in your bank account for selling that covered call. There's gonna be some fees and stuff like that, but that's basically it. This stock is not, in terms of yield, it is high, but it's not as high as some other ones. I did some other trades yesterday, like on Tesla, for example, where you have to obviously put a lot more money down. I think the stock price was at 670. So if you have to buy 100 of those, so that's $67,000, and then you were able to sell the covered calls, I believe, at $40. So a significant amount of money on the covered calls, $4,000 on sale of the call option, but yeah, you had to put an investment of $67,000 in order to do that. So this is kind of an extreme. This is probably one of the very high yield that we have, and we have other ones that really, Apple, the yield on those was really insignificant. It's not the stock I would recommend. These are slightly different pick than usual. There's also the ones that work that have the highest yield often are not the best stocks. So that's something also to remember. But if I just take this as GameStop as kind of a metric for that, of how much money you need. So that means that for that $43 price, I get $945. So how many shares do I need? Well, I would need like 600 shares of that at $43. So that would be about $25,000. If I have something like Tesla, well, I need to put $67,000 in order to get $4,000. So maybe I need maybe I would need like 200 shares really to make it worth it. So it'd be $140,000 that I would need in order to get like $8,000 then in passive income. So you can see there's a wide range here. It depends then which underlying stock do you prefer. Do you prefer Tesla or do you prefer GameStop? The biggest risk here is that the stock keeps going down and down, and that may not be ideal. You may have to exit that position. So there are some risks associated with that. But if you look at GameStop, so GameStop, $25,000 to get that $1,000 of passive income. So you would need between $100,000 and $200,000, maybe $300,000 in order to be on the safe side, in order to achieve that strategy. So this is a pretty small amount compared to what you have to do on the dividend or the 4% withdrawal rate. This is something to keep in mind and to play with. I recommend that you kind of look at that and research that a little bit more. But again, you need some skills. You need to really understand the strategy very well. Look at all the different scenarios. You also need to pick the right stocks for doing the strategy. So it may not be the stocks that you really like. And there are some risk involved. There's some risk that the underlying stock would go down. There's some risk that and this is your passive income strategy, so it's not that passive. You need to be active at least once or twice a month to make sure that this works out pretty well. Well, thank you for watching this video. I hope you learned something and it kind of opened up your mind on some strategies for achieving passive income using the stock market. If you like this video, don't forget to click the thumbs up. If you like anything related to business, investing, real estate investing, achieving financial freedom, make sure that you subscribe to the channel and click that notification bell to be notified whenever a new video is posted. I post videos about 3 times a week. Make sure that you watch the rest of the videos on my channel if you like these topics, and make sure that you click that thumbs up. The YouTube algorithm really likes it and then distributes these videos to a broader audience. Thank you for watching.